Understanding junk bonds, high-yield investment opportunities. Junk bonds, often termed high-yield bonds, represent a unique segment of the fixed-income investment landscape. These bonds, characterized by their heightened risk of default, serve as both a financial tool for struggling companies and a potential investment opportunity for those willing to embrace the associated risk. Understanding the nuances of junk bonds is essential for investors looking to diversify their portfolios or speculate on high-return instruments. What are junk bonds? Junk bonds are debt securities issued by companies or entities that have poor credit ratings, specifically those rated below investment grade by credit rating agencies. These bonds promise regular interest payments, along with the return of the principal amount at maturity, much like traditional bonds. However, the term junk refers to the issuer's financial instability or low creditworthiness, which raises the risk of default, failure to make interest payments or repay the bond principal. Key characteristics of junk bonds. 1. High risk, high reward. Investors are enticed by the potential for higher yields when investing in junk bonds. To compensate for the increased risk, these bonds offer higher interest rates compared to their more reliable counterparts. 2. Credit ratings. Junk bonds receive ratings from agencies such as Standard & Poor's or Moody's. Bonds rated BB or below are classified as junk or speculative grade. These ratings play a crucial role in determining interest rates, with lower ratings indicating a greater risk. 3. Purpose and utilization. Companies often issue junk bonds to raise capital for expansion, refinancing debt, or even to remain solvent. Despite the risks, these bonds can provide essential funding for companies looking to improve their financial standing. The mechanics of junk bonds. Yield and coupon payments. When investing in a junk bond, the investor essentially provides a loan to the issuer in exchange for regular interest payments, referred to as coupon payments. For example, a junk bond with a face value of $1,000 and an annual coupon rate of 8% would pay the investor $80 per year until maturity. These coupons are attractive to investors even when the bonds come with significant risk. Price volatility. Junk bonds tend to exhibit higher price volatility than higher-rated bonds. This volatility can be driven by factors such as changes in the issuer's credit quality, economic conditions, or market sentiment. For instance, if investors believe a company will improve its financial position, they may flock to its bonds, driving prices up. Conversely, negative news can lead to sell-offs and a rapid decrease in bond prices. Market dynamics and indicators. Junk bonds can act as market indicators, signaling overall economic conditions. When market sentiment is optimistic, investors may show a greater appetite for riskier assets like junk bonds. Rising interest in these securities often correlates with a positive outlook on economic growth, whereas a decline in demand may indicate increasing caution among investors. Junk bonds as an economic barometer. An active junk bond market often reflects investor confidence and willingness to take on risk. Conversely, a sell-off in junk bonds typically signifies concerns about economic stability or the health of certain sectors. Therefore, monitoring the performance of junk bonds can provide insights into broader financial trends and market psychology. Investing in junk bonds. For those looking to invest in junk bonds, there are various avenues available. Investors may choose to purchase individual bonds directly or invest in mutual funds or exchange-traded funds, ETFs, focused on high-yield bonds. Junk bond funds allow investors to spread risk across multiple issuers, thereby mitigating the impact of any single bond defaulting. Pros and cons of junk bond investing. Advantages. Higher returns. The potential for higher yields can be attractive, especially in a low-interest rate environment. Market timing opportunities. Investors can capitalize on price fluctuations if they anticipate improving company performance or favorable economic conditions. Disadvantages. Increased risk. the likelihood of default is significantly higher for junk bonds compared to investment-grade bonds, which could result in substantial losses. Economy sensitivity. Economic downturns can exacerbate the risk associated with junk bonds, as financially distressed companies are more likely to default on their obligations. Credit ratings, a critical factor. Credit ratings provide a snapshot of a company's financial health and the associated risks of its bonds. Rating agencies assess the likelihood that issuers will meet their debt obligations, assigning grades that guide investor decisions. Investment grade bonds rated BBB and above are generally considered safer, as they carry a lower risk of default. Speculative grades, bonds rated BB to D indicate varying levels of risk, with D signifying a bond in default. Understanding these ratings and their implications for yield and risk is essential for informed investing in the junk bond market. Real-world applications, a case study of Tesla. A notable example of junk bonds in the corporate world is Tesla Incorporated. In 2014, Tesla issued bonds rated B- by S&P, indicating a speculative grade rating. By late 2020, the bond was upgraded to BB-, showing improved financial conditions albeit still within the junk bond territory. Despite its perceived risks, the bond traded at a significant premium due to the company's soaring stock price and the bond's convertibility into equity. This illustrates how the performance of underlying companies can dramatically influence junk bonds and their appeal to investors. Conclusion. Investing in junk bonds can offer enticing yields and opportunities for growth, but they come with significant risks that require careful consideration and due diligence. By understanding the fundamental characteristics of junk bonds, the role of credit ratings, and the broader economic implications, investors can navigate this complex market effectively. Clearly, junk bonds represent both a challenge and a potential pathway to rewarding investments, making a nuanced approach essential for anyone looking to explore this aspect of the fixed income landscape.